What if I told you that Manchester's property market is set to outperform London by nearly 7% over the next 3 years? And investors are already cashing in. Here's the thing. While cities like New York and Sydney are pricing people out, Manchester is quietly becoming one of the fastest-growing property hotspots in Europe. And no, we're not talking about cheap student housing. I'm talking about high-yield, prime real estate delivering up to 7.95% rental returns, with entry prices still below £300,000. Take a look at this chart showing average yields in Manchester compared to London and Sydney. Rental yields, Manchester versus London versus Sydney, 2025. Now the big question is, are you in or are you watching from the sidelines? Because in this video, I'll show you exactly where the smart money is going in Manchester right now, and how high net worth investors are using this window of opportunity to scale their portfolios before prices take off. Stick around, because by the end of this, you'll know exactly where to invest, what to avoid, and how to stay ahead of the next big wave in UK real estate. Manchester 2025, the next big play for smart investors. Manchester isn't just having a moment, it's leading a movement. And if you're watching the numbers like I am, it's impossible to ignore. Manchester's 19.3% projected house price growth through 2028 isn't a speculative guess. This city is already outpacing London and other UK markets. And while we've seen hotspots rise and fall, remember Miami's condo boom in the early 2000s or Sydney's meteoric price climbs in 2017, Manchester's growth is backed by fundamentals, not hype. Let's break down exactly why this market is different and where the smartest investors are putting their money right now. Manchester's fundamentals. Why this market is heating up. First, population growth. The city's population has surpassed 600,000, and another 100,000 people are expected to move into the city center by 2026. That's not just a stat, that's demand. And when demand spikes while supply stays tight, prices move. Take a look at this chart showing Manchester's population growth over the past decade. Manchester population growth 2014 to 2025. Now combine that with job creation. Microsoft and Amazon have already set up major operations here. Media City UK, home to the BBC and ITV, keeps expanding. These companies aren't just bringing jobs, they're bringing high-income tenants who want modern, well-located housing. I had a conversation with a developer last month who's been building in Manchester for 15 years. He told me, "I haven't seen this level of corporate interest since London's tech boom in Shoreditch back in 2012. And if you remember what happened to prices there, well, you get the picture. Rental yields that crush global competitors." Let's talk about rental yields. Right now, Manchester's citywide rental yield averages 6.9%, with neighborhoods like Salford Quays reaching up to 7.95%. Compare that to London at 2.9%, or Sydney's core neighborhoods hovering around 3.5%. Check this out. Here's a comparison of average rental yields across Manchester, London, New York, and Sydney. Rental yield comparison, Manchester versus London versus New York versus Sydney, 2025. And what's more compelling is the affordability to entry. In Manchester, you can acquire a high-yield property for £250,000 to £320,000. That's about $310,000 to $400,000, which is less than the average deposit required on a mid-tier Manhattan apartment or a Sydney terrace home. Strategically, this gives investors, especially those from North America and Australia, a way to diversify globally without over-leveraging. The mortgage landscape. Why timing is critical in 2025. Now here's something I'm watching closely. Mortgage rates. In February 2025, the Bank of England cut its base rate to 4.5%, which brought 5-year fixed mortgages to around 4.69%. For context, that's significantly lower than Canada's current 5-year fixed hovering at 5.25%. and far more stable than the variable rate chaos we're seeing in the US. If you lock in now, you're potentially riding a stable rate until 2029. But, and here's the kicker, analysts are hinting that we might see rates fall again by late 2026 if inflation cools. A mortgage broker I spoke with in London summed it up perfectly. This is the window where rates are still high enough to weed out over-leveraged buyers, but low enough to make acquisitions smart. Take a look at this breakdown of average mortgage rates in the UK, US, Australia, and Canada. Average 5-year fixed mortgage rates, UK versus US. US versus Australia versus Canada, Q1 2025. Prime investment hotspots in Manchester. So where exactly should you be looking? Here are the 3 areas drawing serious attention and serious capital. Ancoats. Ancoats has transformed from a gritty industrial zone into one of Manchester's most vibrant neighborhoods. Think Brooklyn's Williamsburg circa 2010, but with British charm. You're looking at £320,000 for a modern flat, delivering 6.2% yields, and there's still room for 5% annual appreciation over the next 5 years. The tenant pool? Young professionals working in tech and creative industries. I walked through a new development here last month. Sleek architecture, co-working spaces, rooftop terraces. It's exactly the kind of place that commands top rents. Salford Keys. If you're aiming for yield, this is your zone. With units starting at £250,000, you're looking at 7.95% returns, driven by Media City UK's growth. It's not just a media hub anymore. Fintech and health tech companies are moving in too. An investor I know bought 2 units here in 2023. His rents jumped by 12% last year alone, and both properties are now valued 20% higher than his purchase price. For high net worth investors, this is one of the few places where you can scale quickly without compromising returns. Northern Gateway. This is Manchester's biggest regeneration project, backed by a £1 billion public-private investment. Early entry prices are around £200,000 to £300,000, and projections suggest some of these assets could double in value by 2030. It's a long game, but infrastructure investment here, including new rail links and green spaces, is laying the foundation for massive capital growth. If you missed out on East London's Canary Wharf before it took off, this might be your second chance. Policy and regulation, how Manchester stacks up against global markets. Now, for those of you investing internationally, policy matters. Unlike Canada, there's no foreign buyer ban in Manchester. Unlike Australia, you're not slapped with an 8% foreign investor surcharge. Stamp duty exists, sure. There's a 5% surcharge for second homes, but that's small change compared to Vancouver's 3% vacancy tax or Sydney's surcharges. Here's something to watch, though. The new EPC regulations requiring a C energy rating by 2028 could cost £10,000 to £15,000 per property if you're buying older stock. But many of the new builds in areas like Ancoats and Northern Gateway already meet or exceed these standards. Here's a comparison of foreign investor regulations across the UK, Australia, Canada, and the US. Foreign investment rules, UK versus Australia versus Canada versus US, 2025. Opportunities versus risks, what every smart investor should weigh. I get this question a lot. What's the catch? Here's the truth. Every market has risks. Interest rates could spike unexpectedly. There's 11,765 new units currently under construction across Manchester, which could cool rental growth if demand slows. But when you compare these risks to global counterparts, Manchester offers more upside than downside. Ancoats and Salford Keys have waiting lists for rentals. Vacancy rates in these zones are below 2%, far outperforming London's 4% or New York's 6%. Take a look at this chart of vacancy rates in top global cities. Rental vacancy rates, Manchester versus London versus New York versus Sydney, 2025. And one more thing, capital is still flowing. Private equity funds from Canada and the US are actively acquiring blocks of units here. That level of institutional confidence, it's telling. The real story, a lesson from a savvy investor. Let me share one final story. James, a private equity investor from Toronto, bought 2 flats in Salford Quays in early 2023, £250,000 each. By mid-2025, his properties are valued at £300,000 each, with £1,600 per month in rent rolling in. His total ROI, nearly 30% in 24 months, including rental income and appreciation. Meanwhile, his colleague stayed in Toronto, investing in pre-construction condos that are now delayed 2 years, with lower than expected rental yields. James told me over coffee last month, Manchester was a no-brainer. It's got the growth curve of Sydney in 2013, but without the entry barriers. Actionable strategies. How high net worth investors are positioning themselves in 2025. So if you're watching this and thinking, this all sounds great, but where do I start? Here's a simple playbook I've seen successful investors use, and it's working right now. First, lock in financing while rates are relatively stable. A 5-year fixed at 4.69% gives you predictability, and you can always refinance later if rates come down in 2026 or beyond. Take a look at this chart showing UK mortgage rate trends versus global benchmarks. 5-year fixed mortgage trends, UK versus US versus Australia. 2021 do 2025. Second, decide your strategy. If you're looking for steady cash flow, go for Ancoats flats at £320,000. Rent them for £1,650 per month and hold for incremental growth. If you want high yield with scalability, buy 2 Salford Quays units at £250,000 each, rent them at £1,600 each, and bank nearly £40,000 annually in rental income. If you're the long-term equity builder, Northern Gateway offers early access opportunities starting at £200,000, with projections to double in value by 2030 as the regeneration plan unfolds. And finally, build in EPC compliance costs if you're buying second-hand. Budget £10,000 to £15,000 and make sure you're factoring that into your ROI calculations. But don't overthink it. Many new developments are already compliant, and the demand for energy-efficient housing is growing, meaning future tenants will prioritize these upgrades. How Manchester compares to global markets right now? I get this question all the time from my clients in New York, Sydney, and Toronto. How does Manchester stack up to what I can buy here? Let's look at the numbers. A £320,000 property in Manchester offers 6.2% rental yields in a market with 19.3% projected growth through 2028. In New York, you'd spend $1 million for a condo that yields 2.5%, with far less upside. Sydney? Similar story. Higher buy-in, lower yields, stricter foreign investment rules. Take a look at this side-by-side comparison chart. Property investment ROI. Manchester versus New York versus Sydney versus Toronto. 2025. And let's not forget taxes. The UK's stamp duty surcharge is 5%. In Vancouver, you're dealing with a 3% empty home tax, 5% foreign buyer tax, and ongoing speculation taxes. In Sydney, you're hit with foreign investor stamp duties up to 8%. If you're aiming for maximum efficiency, capital appreciation, strong rental yields, and fewer regulatory headaches, Manchester is punching well above its weight class. What's the smart money doing? Institutional funds aren't sitting on the sidelines here. Just last quarter, a US-based private equity firm acquired an entire block of apartments in Northern Gateway, worth over £50 million. Canadian pension funds are quietly moving capital into Salford developments. And a family office in Melbourne is underwriting a £20 million build-to-rent project in Ancoats. These aren't speculative plays. These are calculated moves by groups who've done the math and want first-mover advantage before Manchester's next price surge. Here's a chart showing recent institutional investments by region, institutional property investments in Manchester by country, 2024/2025. The big takeaways, what you need to know before you invest. Before we wrap up, let's hit the key points you'll want to remember. Manchester is projected for 19.3% price growth by 2028, making it one of the UK's top-performing cities. Rental yields average 6.9%, with hotspots like Salford Quays reaching 7.95%, far outperforming London, New York, or Sydney. Entry prices remain accessible between £250,000 and £320,000, making Manchester attractive for scaling a portfolio without excessive leverage. Favorable policies for foreign investors, without the harsh taxes seen in Canada or Australia, make this market more accessible. Major regeneration projects, including Northern Gateway and Media City UK expansions, are driving tenant demand and long-term value growth. And here's the thing. Every smart investor I know is acting now, not waiting. The opportunity is real, and time is the only thing that could change the math. Don't miss out on Manchester's 2025 window. So, where does this leave you? You've got 3 clear plays in Manchester right now: Ancoats for steady returns, Salford Quays for high yields, and Northern Gateway for long-term appreciation. Now I want to hear from you. Where's your money going? Ancoats' urban vibe, Salford's media hub potential, or Northern Gateway's future-proof strategy? Drop a comment below. I read every one of them, and I'd love to hear your thoughts or answer your questions. And listen, if you found this video helpful, don't just move on. Hit that like button, subscribe, and turn on notifications. Because the next time I break down an opportunity like this, it might be even bigger. But only if you're here to catch it. The best deals always go to those who move first. And if you're serious about diversifying globally and building lasting wealth, you don't want to be the one watching from the sidelines when Manchester's market leaves the station. This is EstateScope, where smart investors get smarter. See you in the next video.